what drives long-term results beyond just property count or a price point, and how to go about making decisions that are going to fit your life and not someone else's strategy or what they're telling you that you should do. Decision isn't so much about how many properties, but what mix is going to best support cash flow, borrowing capacity, and growth, and fit your overall situation without causing too much stress. When we project things forward to 2040, you're looking like having around 109,000 in passive income. So not quite hitting our goal that we were working towards of 144K yet. What sort of savings and cash flow you're going to be left with, and ensure that you're able to hold these properties through the worst of times. And if you're never forced to sell, that has an incredible value to it, because I've seen people really struggle and be forced to sell assets, and that's really undone them.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
I often get asked, should I buy one high-quality property or multiple lower-priced ones? I'm your host, Jared Mann, and today we're going to dive into this topic. And the answer that I often give tends to frustrate people a bit, which is it depends. I want to run through why in today's episode, because it's not a simple answer. It involves really having clarity on what the person's situation is, what their end goals are, then what their risk profile is, and what sort of balance they want to have on their lifestyle and the other parts of their world, not just investing. So today you're going to walk away with a deeper understanding as to what drives long-term results beyond just property count or a price point, and how to go about making decisions that are going to fit your life and not someone else's strategy or what they're telling you that you should do. So let's start with a bit of a case study, and I'll unpack this for you. We've got John and Mary, profile of a typical client that we see. 45-year-old, similar in age, got 2 kids in primary school. So the wife is now back at work after having some time off when their kids were younger. So got 2 incomes in the household with approximately 200,000 combined household income. They've managed to get around 550,000 worth of savings or equivalent equity. Their borrowing capacity as it stands is 1.7 mil, and that's without any extra rental income being counted. So when we look at the rents that we're going to get on the property, if it's got a higher rental yield, that's going to help borrowing capacity by more. And their ability to save after doing a bit of a family budget and working out what they could put towards their investing is 4K a month. So they haven't invested yet, or they might have made some earlier investments that didn't go well. And over most recent years, they've just been focusing on saving and paying down debt, focusing on their family. And they could be feeling that time's running out or that they've missed the boat. So there's still definitely opportunity. But when you approach things a little later in life, you're more focused on not wanting to make mistakes and getting it right, because you've got less time than if you'd started in your early 20s or 30s. So one of their goals is to have a passive income of 100,000 in today's dollars by the age of 60. And that's assuming that they've managed to pay off their home as well, so that this is just going towards living expenses and entertainment, and they don't have to pay a mortgage. And the priorities for them is really having stability. They don't want to do anything to risk everything. They want balance on their lifestyle and their what they can spend on holidays and their saving, and not just be all about investing. And they want to have relatively low stress, so nothing taking over their world. So John and Mary represent many of our clients, great incomes, decent savings, but caught between that fear of missing out and the fear of making a mistake, but knowing that they need to do something. So let's now take a look at their future goals and where they're trying to head to. So when we look at their goal of 100K in passive income by age 60, that's 15 years away. And in future dollars, that would be 144,000, allowing for inflation, because money's not going to buy the same amount when they're 60. So we need to allow for that and work towards a target of 144K. And they need assets to grow their asset base an income that is going to compound over time to get them to their goals. So there's kind of two main ways that they can reach this goal: in passive income alone, or having the equity to give them options to convert that into higher income producing assets at the time that they get to this point. So I'm very conscious that our couple, John and Mary, aren't wanting to take over the world. They're wanting to keep things safe. They want to create wealth without wasting money, without making mistakes. They're not aiming to be moguls, just comfortable and secure and have that freedom later in life. So their decision isn't so much about how many properties, but what mix is going to best support their cash flow, their borrowing capacity, and their growth, and fit their overall situation without causing too much stress. So when we look through 3 different scenarios that I've put together, I think they're going to really surprise you. And there's other options that we could look at, and it would very much come down to tailoring things even further depending on their preferences. But I'm just going to give you 3 scenarios to give you a sense that it's not always what you should do isn't always what you think or what everyone tells you. So first scenario is to go and buy a high quality property. I mentioned earlier that their borrowing capacity was 1.7 mil. So when you go and buy a high quality property, you need to appreciate that the yield is much lower, likely to be, we're going to target a yield of about 3%. We're going to target a future growth rate of 7%. Overall, the growth and the yield tend to come out to being around 10% total when we look at the mix between the two. And we're going to borrow at 80%. So key results here when we project things forward. When we look at that goal age of 2040 when they're 60, it's projected to have a $2.8 million equity by that point, not have been able to make too many other savings, so minimal to nil other savings because most of the time they've been propping up this property. And the property itself is actually still $18K negative per year before tax. And in the short term at the beginning, cash flow is going to be very tight. It's going to be the tightest under this scenario because they're buying a higher priced property with lower yield. And in the first year, it's projected to have a negative 66,000 before tax. So pretty difficult pill to swallow for most people, difficult to handle that cash flow. So is still possible for them, but it's going to reduce their monthly savings ability down to about $1,000 a month from their current $4,000 a month. And when we project forward and look at where they might be at 2050, the property is projected to have a $7.7 million total equity. And at that point, it's projected to have a $9K passive income before tax. So certainly not setting the world on fire. They haven't gotten to their passive income goal through the rent alone. They'd likely have to sell this asset and convert it into index funds or a commercial property or something that gives them a higher rental yield. And so downside is that we've got one single asset. Once it's sold, it's sold and gone. But there's been a big upside there with that equity growth that they do now have. Lower yield means that they've been banking on those strong capital growth, and that's why they need to be ultra selective if they were wanting to execute on this to ensure that position to get this growth, because otherwise it will have been all for nothing. It's going to be much harder for them to duplicate this. So they could technically be able to buy again in around 10 years with a borrowing capacity at that point of $1 million. But it's going to be very hard to be adding properties that much later in the game. And it may actually take them further away from their goals rather than closer. And by that, I mean that the properties aren't going to have enough time to compound, especially on the rent side, and they'll just be contributing more towards a negative cash flow. So not necessarily impossible, but not ideal to be adding properties that late in the game when they're 55 plus, 45 years old now, 55, very close to that goal age of 60. So not really enough time at that point then. And emotionally, this can feel really risky early on because it's costing so much to prop up and can be really difficult to hold in that first year. Big sacrifices on the lifestyle front until the property becomes more neutrally geared. And so it can be pretty hard going. Now, this scenario would fit the advice of go out and buy the highest quality of property that you could buy. But I think there's a big asterisk to that. You have to be able to afford it, and it has to fit your situation. So probably not for everyone when we look at this. There might be some other grounds where you could lower the price point. You're going to get a slightly better yield, but all in all, you're still going to be looking at a fairly strong negative gearing if you're going towards this high quality, lower yield, higher growth sort of option. Now, let's take a look at scenario 2, where we've got 2 mid-range properties. Well, no longer are they that mid-range, but we're looking at purchasing 2 900K properties. So total asset base there of 1.8 million versus in the first example, we had the one single asset of 1.5 million. So immediately before we go crunching any numbers, we can see we've got more assets working for us in the market. And even if the growth on these individual assets is a lesser rate, because we're controlling a larger asset base, that's where the benefit can be. So the yield that we're targeting here is a 4.5% rental yield. In the first instance, we only had a 3% rental yield. That's why it was so hard to hold. So let's project things forward. Initially, you got a better balance. So it's projected to be costing you about 26K per year. And your monthly savings is projected to decrease around to $3,000 a month once you get all your tax back and you've had a pay rise for the year and your rents have gone up in line with historical averages of 4% per year. So much more affordable compared to what it's taking. In the first instance, you're only left with the ability to save about $1,000. You're still able to save about $3,000 after tax. So that's a lot more affordable now from the beginning. When we project things forward to 2040, you're looking like having around 109,000 in passive income. So not quite hitting our goal that we were working towards of 144K yet. And you're projected to have 167,000 passive income by the year 2050 when you were 70. But you don't just get to 60 or your goal age and suddenly everything stops. You'd want to keep living for 10, 20, 30, 40 years beyond that goal age. So that's going to give your properties more time to compound both in equity and rents. So even though here in these examples, I'm just looking at when you're 60 and when you're 70, hopefully you'll still be around when you're 80 and when you're 90, and the picture's only going to be looking better than that. So we had 109K passive income at age 60, 167K by age 70. We've got a projected total worth of 7.7 million. So that compares to when we had scenario 1, let me go into the numbers here in a bit more detail. So at 2040, so at 2050, they're both projected to have the same total worth. How is that possible? We've got a bigger asset base in scenario 2 with the 2 properties, lesser growth but bigger asset base, and we've got a stronger positive cash flow sooner, adding to our savings. So 7.7 million in both scenarios, they're coming out to still giving you the same sort of total worth by that age 70 at 2050. At age 60 at 2040, you're projected to have a 2.6 million total worth versus 2.8 million in the first scenario. So slightly less in terms of your total equity, but a stronger passive income is projected with the 109K versus the minus 18K. So overall, I think that's going to be a lot better suited for the majority of people because they've still got a decent ability to save around their investing and have a life and get those holidays in and have the extra money for things. And they were able to buy another investment by around 2032, 2033. So waiting, I guess, 7 or 8 years. And at that point, it still may be possible to slot another one in and you'd tilt it a bit more towards income producing and rental yield focused at that point because you're closer to retirement. So that when you add that other one in, that would tip you over and get you to your goal, I think, of exceeding that 144,000 passive income.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest. showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
So it's more flexible. You can sell one because you've got multiple assets. You could refinance. You've got a few more options there with having two properties instead of just one. Still got reasonable quality. So we're still able to attract a reasonable tenant at a 900K purchase and slightly lower growth potential as a result compared to the first scenario. But you've got a bit more greater stability of income because you're not going to have both properties vacant at the same time in all likelihood. So if one's vacant, that can be a bit more manageable for you as well. So now let's look at the third scenario that I've put together. First scenario, we purchased a high quality, a high-end property, 1.5 mil with a 3% yield and 7% growth. Second scenario, we bought two properties at 900K with a 4.5% yield and a 5.5% growth. Now we're going to purchase two 625K units and one 900K property. So we're going to look at yields for the units with a 5.5% yield, and we're going to factor in a growth of 4%. So much lower growth on the units, much higher rental yield. And I'm using 5.5% because I'm assuming that you've taken strata fees out of that already, because in reality, we should be able to achieve around a 6 or a 6.5%. You take the strata fee out, likely left with 5.5%. So that's why I'm factoring in that higher strata fee in this yield. It's factoring in that it's already been paid rather. And of course, with the 900K property, similar to the second scenario, we've got the 4.5% yield and the 5.5% growth rate. So how do things look initially, and how manageable is this out when you come out of the gate? So presuming that you were able to buy these three properties over the next year, your worst case passive income would be 17K loss per year compared to 26K loss with the two 900K properties. And the worst case monthly savings after tax is projected to be $3,300, so not costing you very much after you've had pay increases, rental increases, and tax deductions returned. So similar level of effect on your savings, but we're controlling a much larger asset base again here of $2.2 million versus 1.8 in scenario 2 and 1.5 mil in the first high quality scenario. So the main benefit to this is when you can control more property, affects your lifestyle less, and even though you've got a lesser growth rate, let's see how this one comes out, because that's where the proof is in the pudding as to what option could work. So the 2040 projections are for 137K passive income, and that was compared to 109K in scenario 2 and negative 18K in the high quality property scenario 1. You've got $1.8 million total worth projected. That's a fair bit down from the 2.6 in scenario 2 and 2.8 in the scenario 1. But when we get to 2050, you're projected to have a total worth of 7.5, which is only 200K down from the other two scenarios, which each equated to 7.7. And the good news is that you can likely buy another property for the portfolio if you wished, around the same time as you can with scenario 2. Being able to buy something around 2033 for about 900K, 900 to 950K. So under both these second two scenarios, you've got options to add to your portfolio a lot sooner and then tip you up. We're very close to the passive income goal with this third scenario at 137K at age 60. So probably don't need to add another property unless you really want to ensure that you've got that the buffer in the bank for it. Now, one of the important things to look at as well is the cumulative comparison. And this is one of the tools we have to compare the scenarios, because we want to look at both the equity and the after-tax income that you're left with and add that up over all the years for a cumulative comparison between the different scenarios to see, okay, what are you actually left with in your pocket? And this is assuming that none of the properties are sold. So you'd have to take tax out later if you did want to convert that equity to, what's in your hand. So at 2040, at that goal age, the high-priced property scenario 1 had a projection of 2.42. This is the total position of rent and equity. 2.99 million was for your medium price scenario 2, 2.99, so about 500 odd K extra there. And it was 3.1 for the lower priced example. And that's really getting a lot of extra income out to add to the equity that was projected to be gained. So overall, you're going to be slightly better off by about 100,000 with that low price scenario. When we look at 2050, the numbers close a little bit closer. So 6.3 mil total for the high priced, 6.7 mil for the median, and 6.87 for the lower price, lower end. So I guess based on this, if it was just about dollars, you'd probably go for the lower end option because you've been able to buy a larger asset base, even with lesser growth rates. You're ending up with greater overall benefit out. But there's always some factors to consider that aren't a part of the numbers. And so I wanted to take you through the pros and cons that aren't showing up in the numbers. When you've got a better quality of property, anyone that's owned a lower end property will tell you that they attract less desirable tenants and more hassles. And the other negative rather, of having more properties is that you've got more complexity. So more emails about them, more paperwork to do when you refinance, more maintenance that comes up that is just a hassle on your world. Overall, more complexity. Those of us that have been investors for a while really have a flight towards simplicity, and that having lots of properties isn't the be all and end all. So there's that to consider as well. And some of the other things that I mentioned a little bit along the way is that when you have multiple properties, it gives you a bit more flexible options. So you could choose, when to sell. You could sell your total asset base down slower and more sequentially. It gives you more options rather than just going and selling one property, then you're out of the property game. If you're retiring and you had the third scenario, you could sell one property, spread out the sales, sell them when you need to. You've also got a greater diversification of assets, so not as risky potentially because you've been able to spread your asset base out and not be solely reliant on the single property doing amazing things. And finally, it is hard to put a price on being able to afford a better lifestyle. So you really need to consider what sort of savings and cash flow you're going to be left with and ensure that you're able to hold these properties through the worst of times. And if you're never forced to sell, that has an incredible value to it, because I've seen people really struggle and be forced to sell assets, and that's really undone them. So you want to look through to stress testing this for interest rates as well, stress testing it for if something happened in the worst case in your world, making sure that it's comfortable to hold. Now, in practicality, what we also see is this is a couple that hadn't yet done any investing, and they've come and said, help me choose how to build our portfolio and what's the right mix for us. And then they can make their choice once they've seen the numbers and they understand the pros and cons of what isn't in the numbers that I just ran through. But in practicality, what happens with a lot of other people is that they've started out by buying lower price properties early on, and that's the best that they could afford at the time, which is what I did. And then they've moved into more quality when their partner has gone back to work and the kids are in school and they've got stronger incomes, and they might have had enough of some of those lower end tenants and some of the hassles. They might have had a property trashed, and yes, they have insurance and we're able to fix it all up and claim it, but are seeking a higher quality to add to their portfolio in the middle stages so they can just ensure that they get the growth and not just the income. And then in the later stages, when we're closer to retirement, people then tend to add the more rental yield focused properties that are going to add to their passive income because they don't have as long to compound. And so rather than going and executing and building up a whole portfolio, I typically see the other situation from people where buying lower quality to begin with, filling it up with a few quality in the middle, and then lower quality, higher rental yield at the end. So hopefully that really starts to show you that property investing isn't about how many you buy. It's about buying well at the right time in a way that's going to be comfortable to hold and best suit your situation. And there's no single right answer. And I would run away from it. Really makes me shudder when I see people saying, we're going to give you a strategy, or we're going to tell you how to build your portfolio. And they're not actually customizing it and personalizing it to the person. They just give them a spreadsheet that says, buy 10 properties, one every second year, and buy them all through us, and we'll build them new and sell you lots of property, and basically just gearing you up to properties that may not even suit, or might be too many and don't suit you, but suit them and what they're trying to sell. So there is a right strategy for you, and I think you need someone to work with you closely, like I do with our clients, to create that customized one-on-one strategy that's going to best suit your situation, that's involving both using experience and knowledge, combining it with software, technology and scenario modeling. And that's really going to help you have clarity on the best way to build your portfolio and have it meet you and work towards your end goals and targets while still having a comfortable life along the way. So some of the things to think about at the various stages of building this portfolio: you're going to have a financial bottleneck, and it differs for people. So the bottleneck can either be cash flow, or it can be equity and deposits, or it can be borrowing capacity. So I'm always looking through to what is going to be that limiting factor for each couple or person, and then designing the portfolio around that limiting factor. Because if you've got really strong borrowing capacity, but don't have the equity and deposit, that's going to hold you back. Likewise, if you don't have the cash flow to fund higher growth, higher premium properties, that's going to hold you back and mean that you need to buy a different type of property. So that's where the customizing and thought needs to be given to around what's the bottleneck and what types of properties are going to best suit the resources that you have from cash flow, equity and deposit, and borrowing capacity. And then think about what balance of lifestyle do you want along the way. And where things become even more complicated, in today's scenario, a couple wasn't planning to upgrade their home and wasn't planning to have any more kids. But things become a lot more complex when you do want to use your investing to fund your dream home upgrade at some point, or you do want to model out transitioning down and decreasing the size of the property that you have as you head into retirement. So these things need to be given even more thought and modeled out so that you can make those personal desires and needs happen along with your investing, and use your investing to make them possible. So if you're ready to figure out what mix of properties best fits your goals, reach out for us to run you through our strategic portfolio plan, and we can show you what's involved and the cost. And I look forward to potentially working with you on your portfolio. Thanks for tuning in today. Hopefully the numbers didn't scramble your head too much, and you've gotten the higher level gist that it shouldn't be one size fits all. And even though we say buy the highest quality of properties, the key there is what you can afford and how that's going to fit into your lifestyle. So thanks for tuning in. Feel free to share this with any friends that might help. And I'd love it if you could post us a review on Spotify or iTunes. Thanks a lot.
Just a reminder that the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.